Hello, in this presentation we're going to be talking about selling stock options. Stock options can be very confusing, but this is going to make them really simple. So as a stock option investor, you can either be a buyer or a seller of stock options. On the right, I have a picture in Robinhood. As you can see at the very top, it has a buy and a sell. What that means is you can either be a buyer or a seller, only those two things. Now, as a buyer, you can only buy, if you look at on the right-hand side, a call or a put. As a seller, you can only sell a call or a put. So with stock options, you can either be a buyer or a seller. As a buyer, you could either buy a call or buy a put. As a seller, you can either sell a call or sell a put. All the other terms you hear with stock options have to deal with one of those four things. Either being a buyer of buying a call, buying a put, or being a seller of selling a call or selling a put. So everything else you hear with options is either one of those things or a combination of those. As a buyer, you're considered more of a gambler. As a seller, you're considered to be more of the casino. Your chances of success improve drastically when you're the seller of options or when you're the casino. From here on out, we're just going to be referring to the seller of options. We're not going to be talking about the buyer of options, just the seller. With selling options, remember you can either sell a put or sell a call. When we're talking about selling options, when someone is selling a put, that put is specifically called a cash secured put. So it's the same thing, selling a put or selling a cash secured put. Those terms can be used interchangeably when you're talking about selling options. And then remember on the other thing you could do is sell a call. When talking about selling options, when someone's selling a call, it's specifically called a covered call. So when selling options, if someone's selling a put, that's called a cash secured put. Or when someone's selling a call, that's called a covered call. We want to be the casino when we're selling options because our success rate goes up so much. I have heard when you are selling options, your success rate is 80% or higher compared to when you're the buyer of options, it's around 20%. In this section, we're going to be talking about part one, or selling a put. We'll eventually get to part two, selling a call. But right now, we're just talking about part one, selling a put. So remember, when you're selling a put, that's also called a cash secured put. Now, before we get to actually selling the put, we need to prepare ourselves for selling this put. There are two things that are very important. The first thing is you want to select a stock that you already want to own. The second thing, you got to determine the price that you would like to own that stock at. Those are two really important things, selecting a stock that you know you already want to own. And then the other thing is being comfortable with a price that you want to own that stock. When you are the seller of options, you do need to have money saved up for it. It's a little bit more pricey to get into selling options compared to buying options, but I'm telling you, the upside with it and just your chances of success is totally worth taking a little bit extra time to save up so you're able to sell these options. So as a rule of thumb, if the stock you're looking at is a $5 stock, you're going to want to have about $5,000 to start. If the stock's $10, you'll need about $10,000 to start. And now for a $20 stock, you're going to need about $20,000 to start. When you find a stock that you want to own and you have your what we call a strike price, or the price you're comfortable for owning that stock, you're going to want to look at a few technicals. In my other videos, I'll explain these more on my channel. But for now, these are the basic technicals you're going to want to be familiar with. The RSI. An RSI that's close to 30 shows you that the stock is oversold. And so that's a good stock that you want to be selling a put on when the RSI is close to 30. The other thing you want to look at is the Bollinger Band, specifically the lower portion of that Bollinger Band. That tends to be the bottom of a stock. And when a stock dips below that, it tends to want to come right up in that Bollinger Band. The other two things to look at are the 50-day moving average. This acts as your first support net. And then the other moving average you're going to want to look at is the 200-day moving average. That acts as your second support net, or the bottom of the stock. So the lower Bollinger Band, the 50-day moving average, and the 200-day moving average are a good indicator of where the bottom of the stock is going to be. So generally, if it dips below that, it's going to come above it. Now, if the stock's way below the 50-day and 200-day moving average, that stock's known as a falling knife, and people tend to stay away from those stocks because they don't have a bottom in it. So those the 50-day moving average and 200-day moving average are a good base for a stock, but once they break below those, you don't have that base anymore. So people call that a falling knife, meaning the stock can just continue to go down because it doesn't have that level of support anymore. When looking at selling a put, the other things to look at, the big one is the delta. So the delta tells you your success rate, meaning the lower the delta, the higher your success rate. So you could actually take the inverse of the delta, and that tells you your success rate. So a delta of 0.2, if you take the inverse of 0.2, that's going to be 0.8. You have an 80% chance of winning that contract. Now with a 0.4, the inverse of 0.4 is 0.6, which is 60%. So you have a little bit less of a chance with the 0.4 delta. You have a 60% chance of winning that contract. So I tend to like to look at stocks or look at the cash secured put that I'm selling to be around a delta of a 0.2 to a 0.4. And remember, the inverse of that tells you your success rate. The other thing to keep in mind is the volatility of a stock. You generally want a stock with a volatility that's greater than 40 because you're going to get paid more money or more premium for that contract. The other two things that are important, and this is a lot easier to manage your position when the volume is greater than 100 or the open interest is greater than 500. Both the volume and open interest correlate to one another. The basics of those, though, are the higher those numbers, the easier it is to close your position and to roll your position, which we'll talk about a little bit later. When selling a put, it's always important to average into a stock, not just throw everything at the stock at once. So it's important to have a strategy to how you're going to dispense your cash. So in this example, we're going to use a $10 stock. So remember, for a $10 stock, you generally want to have around $10,000 saved. You want to give yourself 3 different chances to average into the stock. So let's say you determine your strike price is going to be $10. Instead of writing a bunch of contracts for $10,000 for a strike price of $10, let's say the stock dips to below the $10 strike price and you get assigned those shares at $10. Now your average in that stock is going to be $10. Whereas if you did this cash dispense strategy, your average would be a lot lower if the stock continued to drop. For example, if for the first cash secured put, if you're doing contracts that are worth about $2,500, and let's say the stock dips to below $10, so you end up buying the stock for your strike price, which is $10, now you have a second chance of getting the stock. Let's say you do another contract for $2,500 for $7, and let's say the stock just keeps going down. So let's say now you have bought $2,500 worth of that stock at $10, and now another $2,500 worth of that stock at $7.50. Let's say the stock continued to go down to $5, and that's where you did your strike price for your third go around. And now you put $5,000 for that $5 strike price, and let's say it hit. Now you'd be averaged into that stock at the prices of $10, $7.50, and then at $5. So your average is going to be way lower compared to if you just threw $10,000 at a strike price of $10 and you got assigned. Your average of that stock would be $10. Whereas if you dispense your cash 25%, 25%, then 50%, you're averaging into that stock. So you're going to have a lot better of a strike price or a stock price doing the strategy. The premium or the amount of money you get paid for doing that contract's important. Generally speaking, you want a premium that gives you greater than a 2% on your ROI or your return on investment. For example, if the put that you're selling expires in a month and you have a strike price at $7, let's say for doing that contract, they're going to be paying you a premium of 20 cents per contract. Remember, a contract, when you're selling any option, one contract equals 100 shares of that stock. So to calculate premium percentage, what you're going to do is you're going to take the 20 cents of premium that they're paying you, and you're going to divide that into your strike price, which is $7. That's going to give you 0.0285. You're going to multiply the 0.0285 by 100, which is going to give you 2.85%. So this means that you're getting paid 2.85% in 1 month just off the premium you're making for doing this contract. That's 34% a year that you're making just off the premium for making contracts. So once you do your strike price, you find the expiration date, and you complete that contract, they'll pay you that premium, and you keep that premium no matter what. So let's say after you've done your contract for selling a cash secured put, it's important that you know how to monitor that contract. So let's say that the stock's currently trading at $10 and you do a cash secured put for $9. That's your contract is for $9 within the next month. Let's say the stock just stays above that $9 and a month's passed by. You would do nothing and you would just keep the premium that they paid you for doing that contract, and the contract's going to expire. Now, let's say that the stock gets down to $9 and you're like, hey, you know what? It was at $10 and I was happy to buy it at 10 and I did my strike price for 9 and I'm more than happy to buy it at $9 because I'm getting it for 10% off. Let's say the stock dips down to $9 and it's getting close to your expiration date. You can also do nothing, and now as long as the stock gets to that expiration date and stays below $9, now you have received the stock for $9, plus you get premium that you get for doing that contract. So now you've received the stock discounted. So if you got 20 cents of premium for that and you did a $9 strike price, you're actually getting the stock for $8.80 compared to if you were to just bought the stock right off the bat for $10. So I like using selling puts to basically get stocks at a discount. And then on the third example, let's say, same example, the stock's at $10, you do a cash secured put at $9. And let's say it's, you have a month, but let's say 15 days into the contract, the stock's now trading at $9. And let's say you decide, you know what, I really don't want the stock at $9 anymore. You changed your mind. You can do what we call rolling the position. Rolling the position simply means that you're going to close out that contract for a loss. You're going to actually pay money for that contract. So let's say you pay 20 cents per share to close that out. You would close it out, you'd pay the 20 cents per contract. And then you would open up another contract, and let's say that contract's paying you 30 cents per contract. Now you're netting 10 cents. So you're just going to either extend your date with rolling that out, or you could extend your date and lower your strike price. That's called rolling your position. When monitoring your position, your shares can get assigned to you early. So it's important that you know how to do this calculation to see if the shares realistically will get assigned to you early. That's by calculating the intrinsic value. To calculate the intrinsic value, I'll show you an example on the next slide so it'll make more sense, but you're going to take the original option strike price that you decided on and you're going to subtract the current stock price. That will give you your intrinsic value. The intrinsic value is important to know because it allows you to calculate the extrinsic value. To calculate the extrinsic value, you're going to take the current contract price and you're going to subtract the extrinsic value you got. That will give you your intrinsic value. So the current contract price minus the intrinsic value will give you the extrinsic value. If the extrinsic value is around 10% of the current contract price, then your shares may get assigned to you early. Again, if you decide you don't want the shares early, you could always roll your position. So here's an example that will make more sense. This is a NEO put that I have. So my strike price was $8. If you look on the left-hand side, the very top number that's red, that's going to tell you the current stock price, which is $5.54. Below that, where it says NEO $8 put, that's my strike price that I decided on for NEO. So that's the original option strike price. And then below that is the current contract price, the $2.52. So to calculate the intrinsic value, we're gonna take the $8, my original strike price, and we're gonna subtract the current stock price of NEO, which is $5.54. That's going to give us $2.46 of intrinsic value. Now to calculate the extrinsic value, what we're going to take is the current contract price, the $2.52, minus the intrinsic value. And I need to delete that $2. I have the $2 in between that, but it's supposed to be $2.52 minus $2.46. That's going to give you 6 cents of extrinsic value. And remember, if your extrinsic value is less than 10% of the current contract price, which the current contract price is $2.52, you are at a chance of at least getting these shares assigned to you early. So what does that tell us? If our extrinsic value is 6 cents, and the current contract price is $2.52. Is 6 cents less than 10% of $2.52? It is. 10% of $2.52 is 25 cents. So we're only having 6 cents of extrinsic value, which tells us that these shares could get assigned to us at any time. So what this tells me is if I don't want these shares to get assigned to me early, I would roll the position, meaning I would close this out, I'd pay for it, and then I'd open up another position that's going to pay me more. So that is why the extrinsic value is important, is because it tells you how likely the shares are going to be put on you. A quick note is remember that if this option is out of the money, the extrinsic value doesn't matter because it's all extrinsic value. So let's say that my strike price for NEO is an $8 put, and let's say NEO is trading at like $9. These calculations I wouldn't be able to do because I would have 100% of extrinsic value, meaning that there's no way that these shares are going to get put on me. So this is about rolling. If you decide you want to avoid getting the shares put on you, you would roll your position. To roll your position, you can either, you're going to select a later expiration date, and then you can either keep your strike price the same or you can lower your strike price. So this is known as rolling out and down. So let's say my original strike price was a month out for $9. And let's say now I want to go 3 months out and I could do it for $8.50 and still make money off of rolling. You can do that, or I could keep it at $9 and I'd make a little bit more premium keeping it at $9. With the put contract, you can close it early. Let's say I do a $9 put and the stock all of a sudden goes to $15. I'm going to be up over 75% most likely on that contract. And so I can just I could take my gains, so I can close that contract. I'd pay a little bit for it, but I would lock in the gains to do it. Now we're going to head to part 2, which is selling a call. So let's say we got those shares put on us. We can now start selling a call on those shares. When we're selling a call, this is also known as selling a covered call. And again, we're going to sell a covered call on the shares we got put on us when we originally sold our put. It's important that we sell the covered call above our cost basis. Our cost basis is going to be the price that we paid for our shares from the cash secured put. Remember that you receive premium, so your cost basis is going to be your strike price minus the premium that you got paid. So let's say your strike price is $10 and they paid you 25 cents. Your cost basis for 100 shares would be $9.75 per share. So if that's what we paid for the shares that we got from the cash secured put, we would want to be selling a covered call with a strike price greater than $9.75. Because if we sold the covered call lower than that, we would most likely be losing money on the trade. Or if we sell it greater than that, we're going to, no matter what, be making money off the trade. When selling a call, the technicals that are important to look at least the basic ones, are the RSI. For the RSI, you want it close to 70. That's showing that the stock is currently being overbought. So it's kind of at the peak of people buying it. And then also you want to look at the Bollinger Band. The upper part of the Bollinger Band is going to show the top level of where the stock likes to trade. And remember, if it goes outside of that upper level, it tends to want to come right back in. So those are the two technicals to look at when selling a call. Now, with selling a call, I like to have my success rate around 80 to 90%. So I like to sell a call with a delta around 0.1 to 0.2. When selling a call, a delta around 0.1 is going to give me a 90% of winning the trade. And a delta around 0.2 is going to give me around an 80% chance of winning the trade or winning the contract. It's important to look at the volatility. A volatility greater than 40 is going to give you more premium, or you're going to get paid more money for making that contract. And also the volume greater than 100 or the open interest greater than 500. Both of those, the volume and open interest, are going to make it a lot easier to manage your call. With the premium from a call, it is important, but I'm more concerned about keeping the shares for greater than a year, because my taxes that I'm going to pay on them are going to be way less than if I make a little bit more premium, but then those shares get called away from me because that's a taxable event. So generally speaking, you want to sell your covered call and keep selling it and keep rolling your position, or keep having your covered call contract expire without your shares being called away for greater than a year, because you're going to have more tax benefits doing it that way. Now, with monitoring a covered call, remember, if the stock doesn't reach your strike price, so let's say the stock's trading at $9, you do your covered call at $11 for the strike price in the next month, and let's say it stays underneath that $11 over the next month, you would just do nothing. That would expire. You would keep your premium. Now, if the stock reaches the strike price, so if it reaches that $11, and let's say you are like, hey, I'm happy with the gains that I made on the stock, and you just want to get your shares called away, you could just do nothing. And as long as the stock price is greater than $11 by the expiration date, now you have gained the appreciation of the stock. So the stock going from $9 to $11. So you made money off that. Plus you keep all the premium for doing the contract. Now let's say if the stock reaches $11 and then you're like, you know what, I don't want to get rid of my shares, or you don't want the shares to get called away, then what you would do is you would close your position prematurely, and then you would open up another position for a greater gain than the loss that you kind of have a loss at first because you're closing that position for a loss, but you'd open up another position that offsets your loss and gives you a gain, and that's called rolling the position. Remember, with the covered call, you generally want to wait greater than a year before you get rid of your shares, and this is because you avoid capital gains tax. You'll pay less in taxes if you hold on to your shares for longer than a year. Now, to calculate the intrinsic value of a covered call, you're going to take the current stock price and you're going to subtract it from the original option strike price. It's important to get that intrinsic value because it allows you to calculate the extrinsic value. For the extrinsic value, you're going to take the current contract price and you're going to subtract the intrinsic value. We'll go over an example in the next slide. Same thing goes for a covered call. If the extrinsic value is around 10% of the current contract price, then your shares may get called away from you early. That's what I mean by you may get your shares early. They may get called away from you early, your shares, if it's close to that 10%. If you decide you don't want to have your shares called away early, then you'll roll the position. So on this example, it's a covered call that I have on Square. The green on the very top is the current stock price. So that's $67.80. The next number that says SQ for Square, the $65 call, that's the original option strike price. And the $10.58 is the current contract price. So to get the intrinsic value, what we're going to take is the current stock price, so $67.80, and we're going to subtract it from the original option strike price, the $65. So that's going to give us $2.80 of intrinsic value. Now to calculate the extrinsic value, what we're going to do is take the current contract price, the $10.58, and we're going to subtract that from the intrinsic value, the $2.80. That's going to give us $7.78 of extrinsic value. So is $7.78 less than 10% of $10.58? The answer is no, because $1.058 is 10% of $10.58. So what does this tell us if our extrinsic value is greater than 10% of the current contract price? It tells us that we can just sit back and monitor the position because it's highly unlikely that our shares are going to get called away from us early because our extrinsic value is well above the 10% of the current contract price. Now remember, also with doing these calculations, if the contract's out of the money, then these calculations don't matter. So let's say I have a $65 strike price for the covered call, and let's say Square is trading below that. So let's say it's at $60. I wouldn't do these calculations, but we could see we're in the money because my covered call is at $65 and Square is currently at $67.80. Again, extrinsic value is important to calculate because it tells me how likely that this covered call is going to get executed early, which it's not going to be executed early because I still have quite a bit of extrinsic value left on this contract. Another way that extrinsic value has been described to me is how much meat is left on the bone. So if there's greater than 10% of meat left on the bone or greater than 10% of extrinsic value when you're comparing it to the current contract price, there's still quite a bit of meat left on that bone for you, so you're not going to have to do much. Now, if you have less than 10%, then it's likely that those shares may get called away from you early. You can roll your position like we talked about with the covered call. So if you decide you want to avoid having those shares called away from you, you would just roll the position. For a covered call, you can select a later expiration date. Plus, you could either select the same strike price, or you can select a higher strike price. When you're selecting a later expiration date plus a higher strike price, that's known as rolling out because you're rolling out on the date and you're rolling up on your strike price. So it's known as rolling out and up. Again, with the covered call, if let's say that it's getting close to the expiration date and my strike price is $65, and let's say that the stock's trading at $60, or if it's having a real negative day, and my total gains are around 75%, and I just want to lock in a win, I could go ahead and close that contract early. Remember, I am going to pay a little bit to do that, but that allows me to lock in the gains. In summary, the goal of selling puts and selling calls on the stock that you already want to own is to bring what we call your cost basis to zero. When you're able to bring your cost basis to zero, meaning after you've sold cash secured puts and covered calls on the same stock over and over and over, from that premium that you've received, when that allows you to pretty much own the stock for free or own the stock on the house's money, there's really no risk to you because you're owning the stock with other people's money. That's the really neat thing about doing stocks this way by selling options, is it allows you to eventually with time own these stocks with other people's money. And your risk is, once you're able to do that, your risk is essentially zero. Now, that's not to say that there's zero risk involved, because there's obviously risk while you're selling the cash secured put and while you're selling the covered call, because with that, especially with the cash secured put, if it's a bad stock and the stock just continues to go down and down and down, you can lose money. You can lose money that way. But again, that's why it's very important that you do it on a stock that you're already comfortable owning and you already want to own. This quote by Walt Disney: "The way to get started is to quit talking and begin doing."